we as policymakers, at least in our bank, were starting to see this show up in August of 2007. There was some major banks were starting to take losses on their subprime home mortgages in early 2007, but that didn't really show up in the financial markets until August of 2007, when banks started charging more to each other. Banks have a lot of overnight loans with one another. They usually are at a very low interest rate, almost the same as the Treasury rate. We started seeing spikes in those rates, and we knew something was going on. Things kind of seemed like they settled down for a while. It didn't seem like it was too bad. But then in March of 2008, we had another shock. We had the failure of the Bear Stearns and Company, or the near failure of Bear Stearns and Company. They would have failed. And so what happened there, Bear Stearns was a major investment bank in the United States. They relied on short-term loans they received from other banks and other major financial players to fund their portfolios of subprime mortgages and mortgage-backed securities. Well, the major players started thinking that Bear Stearns just isn't good for these loans, and they stopped lending Bear Stearns money, so Bear Stearns was unable to fund its portfolio of subprime debt. And so the Fed helped arrange a merger of Bear Stearns with JP Morgan, a much stronger financial institution. The Fed kicked in a $30 billion loan to JP Morgan to basically help underwrite that and allow the acquisition of Bear Stearns. But that was another shock, and it was controversial at the time. Things kind of settled down a little bit, but then the heat picked up again in the summer. September 7th was an important date because that's when Fannie Mae and Freddie Mac were taken into government conservatorship. That is, the U.S. government took them over, basically. So many people in the country and the world thought that Fannie Mae and Freddie Mac were government organizations, but in fact, they were private corporations with private shareholders. But they had this ability to borrow money at close to the government rate because there was this implicit understanding that the Treasury was always there to bail them out if they got into trouble. And in fact, it turned out to be true. The Treasury bailed them out and has been bailing them out ever since. But the government had to step in and take over Fannie Mae and Freddie Mac, or they would have collapsed. Those two organizations fund something like 90% of the home mortgages in the United States. Individual lenders make the mortgage loans, and then they turn around and sell them to Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac are these trillion-dollar organizations that clearly were too big to allow to fail. So the government simply took them over and placed them into conservatorship, and they've been sitting there ever since. And then a week later, there was another major shock to the financial system with the failure of Lehman Brothers. Like Bear Stearns, Lehman was a big investment bank that had invested in a portfolio of dicey subprime mortgages and mortgage-backed securities and all these CDOs and CMOs and all these other labels and hybrid securities that almost nobody had ever heard of up to that point. It was a great financial mess. The Fed looked at Lehman Brothers. Barclays Bank was interested in perhaps taking over Lehman. They wouldn't do it without a substantial infusion of cash from either the federal government or the Fed. The Fed, by law, said, Lehman is too sick. We can't make a loan to bail him out. So Lehman was forced to file bankruptcy. But then the financial system started to collapse around us when that happened. The very next day, money market mutual fund investors, and I'm sure many of you have savings in money market mutual funds, started withdrawing their money in rapid succession out of money market mutual funds because one of the money market mutual funds, one of them named Reserve Primary Fund, broke the buck. Reserve Primary Fund had invested in a lot of Lehman Brothers debt. And when Lehman Brothers went bankrupt, the Reserve Primary Fund's assets themselves were called into question, and they could no longer maintain this $1 per share value of the, in essence, deposits that people like you and me had made with them. So they could say, your money is no longer worth, your shares are no longer worth $1, they're only worth 90 cents or something. Well, a lot of people didn't like that, and they started withdrawing money out of all money market mutual funds, not just Reserve Primary. So there's a classic run on these mutual funds. Very much like the Great Depression, when our grandparents were running on their commercial banks to withdraw their checking account balances and their savings account balances because they feared that if they waited till tomorrow, the bank would be out of business. So they better get it today. And so we have these runs on these money market mutual funds. Money market mutual funds are important because they fund a lot of the commercial paper market, a lot of corporate debt, this large certificates of deposits issued by banks from throughout the world. So they're an important part of the financial system. And so it was a very scary time there when you had these runs on these mutual funds. And then you had the collapse of the giant insurance company AIG. AIG had been a classic traditional insurance company, automobile insurance, life insurance, property insurance, and so forth. But they had gotten very heavily involved in credit default insurance as well. And they had underwritten huge billions of dollars of contracts, essentially insuring subprime mortgages and mortgage portfolios. And when those mortgages started going down the tubes, all of a sudden AIG was also going to be on the hook for billions and billions of dollars, which they simply didn't have. Like Fannie Mae and Freddie Mac, they had grown so enormous that it would have been calamitous to allow such an organization to fail. We would have had a massive financial crisis worldwide on the scale greater than what we saw during the Great Depression. So the Fed, along with the Treasury Department, made enormous loans to AIG to keep them afloat and replaced the management of the organization. And that's still an ongoing mess. And the AIG company has paid back a lot of these loans, but not all of them. So anyway, this is the kind of the history of the financial crisis in a nutshell, from the beginning ripples of the crisis to increasingly severe shocks along the way. And so it's not surprising, really, that we got a significant recession out of that. You can sort of trace the history of the crisis by looking at interest rates. What I plotted here is the difference between a short-term rate, the 3-month LIBOR, the London Interbank Offering Rate, which is simply the interest rate that is essentially the benchmark rate on loans between the largest commercial banks in the world. So you and I don't borrow at LIBOR, but Bank of America borrows at LIBOR, and Citibank borrows at LIBOR, and JP Morgan borrows at LIBOR, when they're making short-term loans with each other. Normally, LIBOR is very low relative to the 3-month Treasury bill yield. So this is a yield spread here, if you will, the difference between the LIBOR interest rate and the 3-month Treasury bill yield. So usually that's almost zero. In other words, most of the giant banks in the world can borrow money at essentially the same rate that the US Treasury can borrow money at, most of the time. But beginning in August 2007, they no longer could do that. We saw spikes occurring when these banks started taking losses on subprime, and banks started getting worried about who they were lending to, even to each other. And so things kind of calmed down, but then we had ripples in December, and then March 2008 again was when Bear Stearns collapsed. That kind of got smoothed over with the Fed loan and JP Morgan taking over Bear Stearns. Things calmed down into the summer, but then things really came to a boil when Fannie Mae and Freddie Mac ceased to be viable concerns. Lehman Brothers went bankrupt. You had the runs on the money market funds. You had the commercial paper market essentially drying up. You had enormous spikes in these rates, huge spreads between what banks were borrowing on loans to each other relative to the safe, risk-free rate on treasuries. So a lot of activity. And then as the crisis subsided, these rates started coming down again. And so into 2009, 2010, as the crisis abated, banks were back to borrowing essentially at the same interest rate that the US Treasury can. This little blip here in June of last year is around the first appearance of the Greek problems. The European debt crisis started heating up, particularly with the problems that Greece may not be able to repay its debts. And so you got some ripples going on in the market there. But even despite as significant as the problems have been in Europe, we haven't seen anything, at least not yet, on the scale that we saw during the crisis here in the United States in 2007 and 2008. We also saw the crisis, of course, in our stock market portfolios, our 401ks and our retirement savings thrift plans and so forth. As the crisis got worse and worse and worse, the stock market, just tanked. We all remember, in around March of 2009, when the market had collapsed. It has since come back quite a bit, but it's still not returned to the level of where it had been before the crisis.